Good morning. This is part 2 of bond valuation, and my name is Albert Bure. Today we'll value bonds using Excel. And our question is, consider a bond with par value 1,000, annual coupon rate 10% with a 3-year maturity. Interest rates are currently 8%. Questions. Question 1, what is the price of the bond? Question 2, what is the duration of the bond? Question 3, you graphically show the inverse relationship between interest rates and bond prices. Now, in valuing bonds, we have two methods. We have the PV function in Excel, which I consider a shortcut method. And we have what I call the ideal method for valuing bonds, which is a long one. Yeah, it's longer. Yeah, but it is more intuitive. Yeah, you're able to explain to someone what you are basically doing. So the intuitive method is considered suitable for shorter periods. So if you have a 3-year bond, or 2, a 5-year bond, or 3, even a 10-year bond, you can use the long method. But if you have a 30-year bond, perhaps paying interest semi-annually, that means you have 60 periods. Now that becomes a bit of a challenge. And therefore, if you have longer periods, say 30 years paying interest semi-annually, it would be preferable if you use the PV function in Excel. Okay, so I'll start off with the PV function. But we all know that to value a bond, you require the coupon rate, that is 1. You require the par value 2, and you require maturity. So the first thing we do is to put down the variables. It's important that you write down the variables. So 1, par value or face value. 2, annual coupon rate. 3, maturity. Recall from part 1, bond valuation part 1, we said these 3 will remain constant. So par value remains 1,000 throughout. Annual coupon rate, for our case, it's 10% per annum. It will remain 10% per annum for these 3 years. Maturity in years, so maturity given in years is 3. So that also remains the same or constant. What will be changing are the interest rates in the market. So annual interest rates. So these are the interest rates in the market. That is what will be changing. And for our case, it is 8%. So recall from our part 1, we said to value a bond, you have the periodic coupon payments. And the periodic coupon payments, you get them by multiplying the coupon rate by the par value. So what we'll require down here is to write time. Then we'll have coupon payments. This is annual coupon payments. And then we require the present value of annual coupon payments. So we start off with the long method. So 1, 2, 3. We have 3 years. Now allow me to increase the font to 16. Okay, so I said for you to get the coupon payments, you multiply the par value by the annual coupon rate. So you say equals 1,000, click on 1,000, and because 1,000 remains constant, you put $sign. If you are using a MacBook, it is the command CMD, you press that one and then press T, and it puts $sign for you. If you are using an HP, simply press F4. It should be able to put $sign for you. So 1,000 multiplied by the coupon rate, which is 10%. Again, command CMD, press that and then T, and it puts $sign for you. The $signs make those cells constant. So we say you make them absolute cells. So enter. Then you copy this down. Now remember from theory, we said you will receive the coupon payments. Then in the final year, you receive the coupon payment for the final year plus the par value. So in year 3, we need to add 1,000, which is the par value. So I'll put the coupon payments in brackets and then add 1,000. So in year 3, you receive 1,100. So the first principles are done. We've received the coupon payments. Now, we are supposed to get the discounted coupon payments. So present value of annual coupon payments, if you recall. Yeah, the formula was RCB multiplied by 1 over 1 plus R from the theory. So we are basically saying we want to discount these coupon payments to the present. So what you'll do is you say equals 1,000, that's 100, sorry, 100 divided by, into brackets, 1 plus R. So pick this one and put $sign on it, plus R. R is the annual interest rate, 8%. Put $sign, close the bracket, power 1. So we are discounting the 100 received at the end of year 1. We are discounting it to the present. Sorry. So that gives you 92. Now, we go back to 92. You double click, you confirm the formula is correct. So coupon payments, yeah, that is RCB divided by 1 plus R. Yes, 1 plus R, R is 8%, then power 1. So that is correct. And since it is correct, what we do next is to copy this down to year 3. Yeah. So we now have the discounted amounts. So the next thing you do, if you recall, we said the summation of the discounted cash flows. So we sum, say equals sum, brackets, then you sum, yeah, and it gives you 1,051.54. So that is the price of the bond. If the coupon rates are 10% and the interest rates in the market are currently at 8%. Now, I'll take you back to the principles. We said there is a relationship between changes in interest rates and bond prices. So at 8%, our bond price is, so this is interest and this is price. So at 8%, our bond price is 1051.54. What if interest rates change from 8 to 10? Let's see, at 10, the bond price will be 1,000. So we'll say 10%, the bond price is 1,000. What if interest rates go up again to 12? So put in 12, and we'll say at 12%, the bond price is 951.96. Now, this is what we discussed in part 1. When interest rates are low, the bonds sell at a premium. When the interest rates in the market are same as the coupon rate, yeah. So when the coupon rate equals the interest rates in the market, the bond sells at par. And when interest rates in the market are greater than the coupon rate, the bond sells at a discount. So that theory is now proven. We've just proved it practically. Yeah. So this is the price of the bond. Now, this is the long method. Yeah. And this is the preferred method. So I'll call it preferred method. Yeah. Because it is intuitive. When you look at it, it makes a lot of sense. You are able to explain to someone what it means. This is a 3-year bond. Yeah, paying coupon rate of 10%. So in the first year, you'll receive 100 shillings. In the second year, you'll receive 100 shillings. In the third year, you'll receive 100 shillings, the coupon payment, plus the 1,000, which is the par value. Yeah. So today, we are saying the price of this bond is 951. Yeah. So you're able to explain to someone, where did these cash flows come from? This is how we get the cash flows. Yeah. This is the preferred method. Now, method 2. In method 2, we use the PV function. So use PV function in Excel. So what do we have? We have par value. We have annual coupon rate. We have maturity. And then we have annual interest rates. Okay, trying to expand this. Okay, so par value is 1,000. Coupon rate remains 10%. Maturity remains 3 years. Annual interest rates are 8%. So what you do is you get the coupon payment. The coupon payment is given by the par value multiplied by the annual coupon rate. You can put $sign if you wish. For this one, you can if you wish. If you don't, you can leave it. Now, we want to use the PV function. So bond price using PV function. So you come here and use equals PV. Yeah. So when you say equals PV, Excel will tell you, okay, you put PV, give me the rate. What is the rate? Yeah. What is the rate for our case? The rate is 8%. Yeah. And says put a comma. What is the number of periods? NPER, NPER means number of periods. What is the number of periods you are going to pay this? 3 times. Yeah. So it gives you the number of times you are going to pay that. Yeah. Then what is the next item? The next item is, so you have number of periods. Then the next item is, what is the payment? Yeah. What is the payment? The coupon payment is 100. So you put 100. Yeah. So we have we have the rate, we have the number of periods, and then we have that coupon. But what you do, put minus on the coupon. So minus on the coupon, yeah. And then close this bracket. That is the first part, yeah. So you have the coupon payments being discounted to the present, but you also get the par being discounted to the present. So when you come to the par, you say plus. Okay. So now you need to get 1,000, yeah, divide by 1. Now we can use the one that was used in the first example, or you can type it in. But if you are coming up with a spreadsheet to value, you avoid typing in numbers, yeah, so that you have these numbers on an Excel spreadsheet. You simply click on those numbers, you link the cells. So 1 plus R, R is 8%, yeah, and we know it is power 1. Okay, some mistake somewhere. C29 is the rate. Okay, let me first check the first bit. 257. That is correct. So it is the second bit that seems to have an issue. So it's 1,000. So we have 1,000. Discount it. Yeah. So 1 plus our 8% power okay. That is it. So let me expand this. This is the second method. Now, let me explain the second method a second time. In the PV function, what you have are the variables. You can see power value 1,000, annual coupon rate 10%, maturity 3, annual interest rates 8%. Yeah. Then you compute the coupon. After you've computed the coupon, you go to Excel PV function. Yeah. Let me repeat that. Let me remove this. I repeat it. So you come to the Excel PV function. So you say equals PV, yeah. Then you put bracket. The moment you put bracket, Excel guides you. What is the rate? Our rate is 8%, comma, and it tells you, comma. What is the number of periods? Our number of periods is 3. It is a 3-year bond, comma, okay? Then it asks you for the periodic payment. What is your periodic payment? Our periodic payment is that coupon of 100. We computed it here. I think it's hiding. Just a moment. Let me insert. Yeah. So our periodic payment is 100. So you have that 100. Yeah. So Excel now knows this is an annuity. Yeah. So we have the first bit where we are getting 100, 100, 100 for 3 years. So put that in brackets. Then add the power value, because you will receive power value at the end of 3 years. So discount it to the present. So you say plus, then you click on 1,000. Yeah. Discount it to the present. So divide by 1 plus R. R is 8%. Close the brackets. Power 3. You have a 3 there. That is the maturity of the bond. Yeah. And then you close that bracket. Then you, now what have I missed out? 1 plus C. A 1,000 divided by 1 plus C 29, that is correct, power. What is C 28? Power 3 to the power 3. That is correct. C 29 is our interest rate. C 28 is wrong because it is the rate. That's the first thing. Then, okay, correct. That's the number of periods is 3 years. And then the coupon, which is 31. Again, let me recheck that. So that is correct. Yeah, that is correct. The reason I'm saying it's correct is because I've not yet put the minus on the coupon payment. When you put minus on the coupon payment, this one, yeah, it becomes a positive. Yeah. So now this is the correct value. So the first part of the equation is correct. Now we go to the second part. So plus, yeah. So 1,000 divided by 1 plus, sorry, 1 plus R. R is 8%. Yeah. Then we discount this by 3, the power 3, sorry. So 1 plus R power 3, yeah. And it gives us 1051. 1051 is the same price we had when our interest rates were 8%. So you can see you have 1051, 1051. So both methods will give you the same answer. But when it comes to the intuitiveness, yeah, you find method 2 is not as intuitive. Yeah, it doesn't look so neat. And that's why I said, if you have many years, perhaps you have a level coupon bond, 50 years, yeah, paying interest semi-annually. Now you can't generate numbers up to 100. That will take you a lot of time. So you can use the second method. Yeah, in that case, you use second method. It's easy, yeah, and it's faster. But for 2, 3, 5, 10 or so years, paying interest annually, use the first method. It's very intuitive because you're able to explain to the person, in the first year, you'll receive a coupon payment of 100. In the second year, you'll receive a coupon payment of 100. In the third year, you'll receive a coupon payment of 100, plus you'll get back your par value. That's how easy it is. So the next part of this is now to compute the duration of this bond. And if you recall, we said the duration is the summation of the present value of the coupon payments times time. So I'll come here and say PVC, present value of coupon times time, yeah. And then for the duration, you'll say PVC times time divide by the summation of the present value of coupon payment. So it is PVCT divided by the price of the bond. So when we come to PVC, PVC is this figure, present value of the coupon payments. So you say equals, so present value of coupon payments multiply by 1. That is the time for the first period. And then you copy this down to the third year and then sum. You sum. You can either use auto sum Yeah. Or you type in equal sum and then you pick what you require. So that is the sum. Now for you to get duration, yeah, it is summation of PVC times T over summation of PVC alone. So it is 2883.70 divided by the price of the bond, 1051. This is the duration of our bond. So the duration of a level coupon bond or a straight bond, yeah, this one is less than, it is time to maturity. This is a 3-year bond. You can say its duration is 2.74. So it's less than 3 years. Why? Because by the time you get to maturity, you'll have received 100, another 100. Therefore, the year of maturity, you receive the balance of 100 plus par. What if it was a zero coupon bond? A zero coupon bond, what you do, you come here and say annual coupon rate 0. And what do you see? The duration is 3 years. Another principle of duration. So duration of a zero coupon bond is it is time to maturity. So if it's a 3-year bond, yeah, 3-year zero coupon bond, its duration is 3 years. If it's a 5-year zero coupon bond, its duration is 5 years. So these are the principles. Finally, for this second part, we'll get the graph. So we want to get a graph. So what we'll do, we have the relationship between interest rate and the price of the bond. So for interest rates, we'll start generating from 0%, 1%, 2%, and then we generate this to say 13% or so, even 14, that is fine. Then what you put against 0% under price is equal sum. So put the formula that gave you the price of the bond, 1051, and you know it is D19, so D19 to D21. So if you pick that one, you can see it has highlighted. You picked it correctly. That is what gave you the price of the bond. So you enter and you have 1051.54. So you come here and highlight next. So you highlight the two columns. Those two are called columns. Yeah. Then you go to data. So you click on data. Then you go to what if. What if is here. So you go to your right, you'll see what if. Click on what if and you'll see data table. Now we've agreed these are columns. So put your cursor in column input cell. And the question is, what do you want? I want Excel to give me the prices of the bond at different interest rates. So I click on interest rates 8, not coupon, interest rate. Then I say, okay. So it has generated for me. And you can see at 8% is 1051, at 10% is 1,000, at 12 is 951. So we can confidently say, yeah, we can confidently say, let me increase the font. We can confidently say the computation is correct. Reducing the decimal places. So all you do is highlight, and then you come to this. If you want to reduce, that one you reduce up to 0. If I want to increase, I come to this one, the one facing left. So 1, 2, I put 2 decimal places. So now I have my prices at different interest rates. So I come and highlight 1 to 14. That is the first step. Next step, I go to insert. I go to insert. The next thing you do is to look for charts. So insert and then you look for charts. The charts are here. Yeah. I want XY scatter. So I'll pick this one, the smooth one. I say okay. And it gives me my graph. So I'll go to the left, expand this. That's the first thing you do. You expand, you activate it first, and you can see this, and therefore you are able to expand. Yeah, you can see this, you're able to expand it up. Now you can see a downward sloping curve. This is the inverse relationship. So what you need to do, change the scale, double click on this value on the horizontal axis. So you double click and it gives you a format axis. You come here and look at measure and say remove 2, put 1, so that your scale moves from 0 to 1 to 2, 3, 4, like that. On the vertical axis, you double click, it's saying the measure scale is, or unit is 200. We want it to be 100. Then you enter. Yeah. And it shows you now 100, 200, 300, 400. Now, perhaps you are interested in writing a story here. If you're interested in writing a story on the plot area, what you're supposed to do is to go to insert. So you go to insert, then look for text box, this one. On your right, you'll see text box. So click on the text box, come and put the text box there. Sorry, text box. Yeah, then you can write your story. This chart shows the inverse relationship between interest rates and bond prices. You can write whatever else you want to write here, but on this chart, you can write there. So this is the end of our second part, and hopefully you found it useful. This is how we value bonds. This is how we compute duration. And this is how we are able to show our inverse relationship between interest rates and bond prices. Thank you so much, and see you next week.